financial events for that company. If there weren't a set of guidelines for accountants to classify financial information and transactions, everyone would have their own different setups, and there would be no standard way to classify this huge amount of information, and complete chaos would ensue.
Accountants must work under a series of rules and guidelines that help them make basic decisions. These guidelines are known as Generally Accepted Accounting Principles, or GAAP.
GAAP is based on a number of accounting concepts and assumptions.
The business entity concept states that businesses are treated separately from other businesses and individual people. Businesses are separate entities from the owners for accounting purposes. Therefore, the assets and liabilities of the business are kept separate from the assets and liabilities of all others, including the owners and creditors of the business.
For example, let's say the owner's a big fan of remote-controlled trucks. She plays every day at lunchtime. The accountant will not count her trucks as company property, even though they're on company property, because they are an asset of the owner. So the bankers cannot use the toy trucks.
The cost principle states that the assets must be recorded in a company's accounts for the cost at which they were originally purchased, not at a perceived market value.
But there's nothing that says that I can't jack up my prices and rip you off. What time's karaoke start at the bar?
An example of the cost principle is our producer, Chris Mattingly. When we first hired him 6 weeks ago, his market value was 4 times what it is today. So even though the company may feel that he's actually worth much less than he cost on the books, we record the amount we originally paid for him.
We can earn revenue whenever we sell a pair of jeans to a customer. The matching principle states that we need to record all the expenses we incurred while selling these clothes, like my salary, in the same time period we record the sale.
GAAP has other principles, but we focused on 3 of the most important. So remember, the 3 principles we discussed are
1. The business entity concept. 2. The cost principle. And 3. The matching principle.
Now let's briefly discuss types of business organizations.
Section C, business organizations.
The 3 types of business organizations are the sole proprietorship, the partnership, and the corporation. Of course, we should mention that each type of organization has different advantages and disadvantages.
To watch more free educational videos, visit our website, studioforlearning.tv. Stretch your brain online.